We averaged a price for our products during the quarter of 212 Australian dollars a tonne. That equates to around 138 US. Newhaul, a privately owned business founded by Craig Mitchell in 2019 and managed the joint venture, now acquired by Fenix.
Well, welcome everybody to today's webinar with Fenix Resources. I'm Danica Warburton, the Investor Relations Representative for Fenix. And as always, I'm delighted to be joined by your Executive Chairman, John Welborn. Today, we're going to run through the December quarter results and importantly, lay out what's ahead for Fenix in 2024.
Danica, and thanks to everyone joining the webinar. I know we've got a lot of questions and I've been asked to keep the summary short, which is difficult because it was, as described, a transformational quarter for Fenix Resources. We made substantial progress and there's a lot to talk about in the quarterly. Focusing initially on a quick summary of our Iron Ridge performance, we had stronger iron ore prices and took advantage of them with our operating margin increasing above $100 a tonne. That's obviously very pleasing. We sold 353,000 wet metric tonnes of iron ore and we averaged a price for our products during the quarter of 212 Australian dollars a tonne. That equates to around 138 US. Very pleasingly, that's a $10 margin above what the 62% spot price index averaged over the quarter, which was around 128 US dollars. So that was largely attributable to the high quality of our products, but also the fact that we sold a lot of lump during the quarter. We actually sold more than 200,000 tonnes of lump, with the balance being fine, and that flowed through into our prices. And at those sort of margins, we're making a lot of money. So the quarterly also shows what we've used it for, which is to fund some growth transactions. So we generated about $35 million of operating cash flow due to the performance of Iron Ridge, and we've reconciled where we've invested that in the transactions described at Beebyn, the work we're doing on Shine, and also we paid some taxes and royalties and made other investments during the quarter. Beyond Iron Ridge, very important quarter, most obviously at our Fenix Ports business, where we exported almost 900,000 tonnes of iron ore. Obviously, that includes the 350-odd thousand tonnes from Iron Ridge, as well as approximately 550,000 tonnes for third-party customers. That demonstrates that we're currently at a run rate through the port of more than 3.5 million tonnes. We believe the sheds that we control there and the on-wharf storage and loading facilities have a capacity of more than 5 million tonnes, perhaps up to 10. So very pleasing, we are on our way there. And our challenge now is to make as much of that material as we possibly can our own material. A great start to what's going to be a big engine for Fenix at the port. In our logistics business, we continue to do well. We obviously disclosed a stable performance in our C1 cash costs during the quarter and very stable on shipping. So our increase in margin of 45% is largely attributable to the iron ore price rising, as well as our production of lump. We did actually see higher mining costs during the quarter. We did quite a lot of stripping, and obviously we're not immune from the inflationary pressures you see across the marketplace. They were offset by ongoing efficiencies in what is a state-of-the-art leading business in our logistics functions, as well as the synergies of the volumes we're now moving through the port. And that's what's kept our costs stable. So great performance from the Fenix-Newhaul team. We disclosed in the quarterly we've completed the consolidation of that business. It's now 100% owned. As part of the acquisition of Fenix-Newhaul, we disclosed that we'd made transition arrangements with Newhaul. Newhaul, a privately owned business founded by Craig Mitchell in 2019 and managed the joint venture, now acquired by Fenix. So Newhaul is providing the strategic and operational management, the finance, administration, HR, IT, procurement, and all the other functions of Fenix-Newhaul under a services arrangement. And people have seen in the annual report, we disclosed the related party payments being made to Newhaul. I'm really pleased that immediately following the quarter on the 1st of January, as part of the integration of Fenix-Newhaul, Fenix has now acquired Newhaul. And so we now have total control over that cost centre. It's part of the business. It's no longer a related party transaction. It's an internal transaction. We excluded assets unrelated to Fenix as part of that deal. And we're now one team working across our business on great outcomes. And you can see those flowing through in the quarterly reports. I'm sure we're going to get a lot of questions about the growth transactions. fundamental game changer is the Beebyn-W11 right to mine agreement, 10 million tonnes. Beebyn's a 20 million tonne deposit at 61% iron ore, so it's a very similar mining opportunity to Iron Ridge. It's 20 kilometres away. We're aiming to get that mining by the end of the year, and that is a wonderful opportunity as we expand operations in the World Range using our infrastructure. We acquired 500,000 tonnes of ore from Twin Peaks, and we've already started trucking that material. It's also high-grade ore. It'll immediately add to our production in the current calendar year. Then we're also obviously working on a recommissioning decision on Shine, 15 million tonnes. So we've got a number of new mining opportunities we're looking to bring online, and you can see how profitable and the rewards of Iron Ridge, and we're looking to add to those. We know we've got the infrastructure in transport, both haulage and port, and also rail access if and when that's required for those expansion plans. Plans are obviously moved from a very successful one mine operation with a limited life to multi-mines with a long life and a sustainable operation in the Midwest. And that's very exciting. So stay tuned for more information as we develop those mines. Very pleasingly, we added significantly to the team during the quarter. Scott Pileggi joined us in a mine management role at Iron Ridge. Jamie Jones joined us as our port manager in Geraldton. People in Geraldton will be aware Jamie's been working for us for a long time through our contracting relationship with Champion Bay Electrics, and we're delighted with the progress he's making at the port. And Goran Seat has joined us here in Perth in a corporate role as General Manager of Projects, because you can see we've got a lot of projects on the go. But with that summary of what's in the quarterly, and hopefully it's a good read for everyone out there, I'm very happy to answer questions, Dan.
Thanks very much, John, and congratulations on the very strong performance, the operational performance in the quarter, and also on those transformational transactions. It's great, as you said, to see Fenix grow from the single mine operator into, I guess, seeing your intention that is to grow Fenix into a really material scale integrated mining and logistics and port services business. I mean, I won't bang on too much. I'm keen to unpack everything you said some more, so we'll jump straight into the investor questions. The first one that I got was through on Iron Ridge, actually, from Bob, and he's asked, with regard to the December quarter, which saw stronger iron ore prices, this obviously resulted in a huge increase in the operating margin for Iron Ridge. Do you think this performance can continue?
Bob, absolutely. We obviously had great iron ore prices. I mentioned they averaged $128. Today, the price is $135. It's actually come off a little bit, but we're seeing higher spot prices than we enjoyed during the quarter. The cash flow generation, the performance of the mine continues. Longer term, looking since inception, we've seen the iron ore price dip below $100, and we may well again. What we've shown is that we can be profitable. We've obviously got hedging protection that cost us during the December quarter, but sustains our business. Obviously, the answer is we are here for the long term, and we're going to make sure that it continues. In terms of the short-term outlook for the iron ore price, it looks very strong. And so we're, as you saw, by prioritising lump during the December quarter, we've maximised our returns and our margins, and we'll continue to look to do that. The short-term outlook looks very good. Long-term outlook, the best hedge we can do is reduce our costs, and the easiest way for bulk commodity miners to do that is increase their denominator, or the tonnes. So you're seeing cost benefits generated by us doing that at the port, and we're about to do that across our business. So we're definitely focused on and confident that we're going to maintain a very strong margin. And look, if you add together our C1 costs of $51 a tonne, with our current shipping cost of $17 a tonne, you get a below $70 CFR number, which equates to that iron ore price currently $135. So there's a lot of room in our margin. The biggest companies in Australia and the richest people in Australia are iron ore miners, and it's something that we recognise at Fenix. It's a big market. Obviously, you're seeing in some of the battery metals, the price dynamics within the commodity markets change. Most obviously in lithium, people are surprised that copper miners, or obviously the nickel miners are going to care and maintenance. That's not our future in iron ore. It's a huge market. We know there are engines and long-term price dynamics of that market that Fenix can be profitable in. So, Bob, stay tuned. We're building a big company.
Okay, I do have a follow-up question on the iron ore piece for you, but I wanted to move to the new projects, particularly the Beebyn-W11 deposit. You mentioned that Workstreams have commenced there with environmental assessments and the native title approval, initial talks with the traditional landowners. When do you expect those approvals to come through and mining to start at Beebyn, and what will it mean for Fenix?
We've indicated that we're ambitiously hoping to mine during 2024. So obviously we've got 11 months until we expect to be mining at W11. Within the Fenix team, obviously, we have the reference point of what was achieved at Iron Ridge, where we commissioned the mine in a very short time frame. And we have the advantage, obviously, that W11 is only 20 kilometres away. And also the Sinosteel Midwest team are partners in that project, and the owners of Beebyn and the whole World Range deposits have done a lot of work that we're including native title agreements and previous environmental approvals, and obviously a great deal of geological work on the resource. So I mentioned Goran's joined us. He's running that project. We'll obviously update the market with more specific timelines, but we're using all the work that's been completed in the work that we disclosed in the quarterly. And I think by the end of the current quarter, we'll have more guidelines around the capital cost and the timeline. But the key milestone is we want to be producing from W11, augmenting our production from Iron Ridge by the end of this calendar year.
Okay, brilliant. And I guess continuing the theme of the new mining agreements that you outlined, Twin Peaks. So you mentioned there that you were going to start producing ore, and this would contribute to some, considerable economies of scale for Fenix. Can you expand on the economics behind the right to mine agreements? We had a couple of questions through from investors, so I've tried to consolidate that one.
Yeah, sure. The ore purchase agreement with 10M is quite simple. They've established a mine. We're acquiring the ore off them at the mine gate, and then we're using Fenix's unique infrastructure capabilities in haulage and port services. There's a cost component for the mining that 10M, the owners of the Twin Peaks mine, are allocated, and then there's a cost component that we're allocated for the transport and shipping component. Then both parties expect to make a margin on that, and then we split the profit 30% to Fenix and 70% to 10M after that split. That's going to be an additional 500,000 tonnes of production for Fenix, and we're going to make a good margin on that business. In relation to the right to mine, the structure there is, we've acquired the 10 million tonnes for an equivalent acquisition cost of $1 a tonne. We're paying a small base royalty of $2 a tonne, and then we're sharing the profits evenly with Sinosteel Midwest on the margins generated from that project. So Iron Ridge is obviously a 100% owned operation, and you're seeing the huge margins we're making there. We're very confident in these partnership agreements that we generate strong margins due to the utilisation of our infrastructure as well as accessing the margin on the material.
Okay. I love talking revenue, as you know. So moving along onto the third-party revenue model and tying into the infrastructure advantage that you just mentioned, the Fenix Port Services business. You mentioned that you signed iron ore producer Kufi during the last quarter, and that's fantastic. So congratulations. Don and a couple of other investors have asked for more detail around the utilisation of your Geraldton Port facilities and how that's going to generate cash for the business, and maybe some details around toll treating of minerals other than iron ore, given that different commodities have different requirements around impurities. If you could.
So the facilities that we now own and control of Geraldton Port include our existing on-wharf storage facility that we've been using for Iron Ridge, which was previously owned by Sinosteel. Mm-hmm. Two much larger on-wharf storage facilities previously owned and operated by Mount Gibson, who have exported 50 million tonnes from Geraldton through their mining operations in the Midwest. So you can see the scale and the potential of those facilities. I mentioned we're at a run rate of more than 3.5 million tonnes. We're on track for a larger number, and we'd like to use those facilities to export iron ore from Iron Ridge, from Beebyn-W11, from Twin Peaks, from Shine, and potentially from other Fenix-owned or Fenix-partnered mines in the region. But we're also very pleased to access those on a profitable basis for third parties to unlock value in other projects in the Midwest. And you've seen that with the very early deal we've done with Coofee. They're obviously commercially confident arrangements. We're confident that we're going to generate significant revenue and profits out of those. If you go back to the Coofee arrangement and contract that we announced in the December quarter, we disclosed that that has a take-or-pay element of 1.1 million tonnes per annum, and that from that take-or-pay element, we expected to generate more than $10 million in revenue. So, that's giving you the market an idea that there's roughly $10 a tonne of revenue in it under that arrangement. Now, if you also look at the quarter, we actually did 550,000 tonnes of third-party tonnes through the port. So therefore, we're on a run rate currently of third-party tonnes of more than 2 million. And you can work out what that might be doing to revenue. Obviously, from a cost basis, our costs of the port are changing as we expand. We're investing, and we're looking at how we use those facilities in the best possible way. And that links into the question of, at the moment, we're exporting iron ore. As we refine and increase our capabilities of the port, we do see opportunities to expand and potentially use those facilities for either our own or other people's third-party bulk commodity products, whether that's lithium concentrate, could be potash, silica sands, garnet, talc, all sorts of things. There's lots of interesting projects in the Midwest. That works ahead. At the moment, we're focused on iron ore and maximising throughput, but we've got lots of optionality going forward.
Okay, and Don actually asked a follow-up question on the spare capacity at the port. So you've got a number of sheds. Is there quite a bit of spare capacity there for this port services business?
Look, when we acquired those sheds, I think we had some photographs in that announcement. If the shareholders might be familiar with them, I used the expression at the time for my own benefit, just to demonstrate scale, that in Shed 5, one of our facilities, you can fit 2 rugby fields end on end. They're absolutely enormous facilities, and they were, the photo demonstrated just how empty they were in the little tiny high-vis myself you could see in the distance. I'm very pleased that if you went back to Geraldton today, those sheds are full, or they look full. We've still got lots of capacity, but across the third-party tonnes that we're facilitating, and the lump product and the fines product and 10M, all of those sheds have been used currently, and we've now operationally tested the ability to store material and load material out of all of them. There is still significant capacity, and Mount Gibson, who only controlled 2 of the 3 sheds we controlled, I think at various points were exporting more than 5 million tonnes a year from Talleyrand Peak and Extension Hill. We know that across our 3 sheds we can significantly exceed those volumes. So there's lots of capacity. Challenge, and our opportunity is to unlock it.
Okay, so you did just under 550 wet metric tonnes in the previous quarter. How do you intend to build and scale the port services business? Is there a target amount of customers? And I guess, do you see it as a growth driver for Fenix as a whole, as a company?
Obviously, the 550 is third party. We did 900 from the facilities.
Yeah.
Gordon, I'd see it as a total, because obviously we want to capture as much of the value chain as we can. We've got a port business, we've got a logistics business, and we've got a mining business. Best application of that business is when we're mining the material and we're hauling it, and we're potentially putting it on the rail, and we're putting it into our sheds, and we're loading it onto ships, because we're really good at it, and we want to capture value out of that whole chain. Focusing just on the ports business, yes, we can do port services for people. We've got available capacity at the moment. We're doing as much as we can, as well as many other people in developing their projects in the Midwest to use all of that capacity. So yes, it's a huge growth opportunity, as there is in our logistics business. And we're working with the key stakeholders in the region, Horizon, ARC, and others, about getting on the rail and building tonnes that way as well. So all of these opportunities are going to be revenue drivers and profitability drivers for us.
Okay. We'll move on to logistics now, because there's been a lot of questions through on the haulage business and the acquisition that you announced of Newhaul. To consolidate all of the questions, would you be able to provide a bit of a rationale behind the acquisition? I know that you touched on that in your intro, and sort of explain, I mean, previously Fenix-Newhaul and Newhaul had divided the contracts. What does this acquisition mean for Fenix going forward? Will Fenix receive 100% of the new contracts, even outside of the Midwest? And Bill has asked if you can comment on specifically the recent announcement by RareX Limited regarding the haulage agreement with Newhaul.
Great. Let's start. So one of the great strengths of Fenix is our partnership, whether it's with the Wajarri people or with the Midwest Port Authority. And a great example of that was the joint venture between Fenix and Newhaul, which created a 50-50 owned haulage joint venture company. And if you go back, and shareholders who've been there from the start of the journey would recognise just how important it's been in our success. The consolidation of that business was very logical, and it's allowed us to significantly reduce cash costs. We disclosed at the time of that acquisition that it was immediately value accretive to Fenix. It has actually ended up being far more value accretive, something that Craig Mitchell reminds me of every day, how good a deal that Fenix has done. Part of those arrangements, though, were recognising that in the joint venture, Newhaul Provided Services pretty much runs that business and has enormous expertise. So we went from having a 50-50 joint venture where a lot of the management expertise, skills, functionality, support was provided by Newhaul under services agreement, to a 100% owned business, Fenix-Newhaul, but it still had management services provided by Newhaul. And if you're a keen follower or an auditor or a chartered accountant, and you actually read the annual report, you'll see that in our disclosure of related parties for the year ended 30 June 2023, we disclosed that $2.1 million had been paid to a related party, Craig Mitchell and Newhaul, in relation to those services. And in the December quarterly that we're talking about today, we disclose related party payments as companies are required to do, of $900,000. Most of those payments are related to those very important services provided by Newhaul. I am absolutely delighted that we have been able to secure the 100% ownership of Newhaul. It's absolutely critical to the strength of the company. So not only do we now have the Fenix-Newhaul business and all the trucks and the drivers and the IP, we've now got the management services that actually are the engine of that business. And we've been able to do that in a way that leverages off the value in the Fenix-Newhaul transaction. So obviously it excludes the performance rights and other milestone payments that related to the Fenix-Newhaul acquisition that sat in Newhaul, and it also excludes contracts that are outside the Midwest. Now, really pleasingly for Fenix, we've got the option to acquire those in future. So the answer to the question of are we looking to expand beyond the Midwest is clear answer is, as you can hear, we've got a lot to do in the Midwest. And I think, our most obvious value opportunity, whether that's within 100% owned Newhaul, Fenix-Newhaul, or Fenix Port Services or Fenix Mining, is to focus in the Midwest. But obviously we look at a lot of different things, and the opportunities that Newhaul is developing with a range of companies, and most recently with RareX, represent wonderful springboard opportunities now for Fenix. We have 100% control of the services function that would provide those contracts, and we now have the option to buy them at the point that they become real. Obviously, that decision will be made about what we're focusing on at the time, and whether Fenix wants to stay in the Midwest or whether we want to expand, but we've got that option. And we now control the key cost centre and provider of excellent management services to that business. So it's a very logical transaction, and you're going, like you have previously, you're going to see the benefits of that transaction as we deliver these projects.
Okay. Midwest is best, but you're leaving the door open for other, like the Pilbara, for instance, if in the medium term.
We've shown at Iron Ridge that we can unlock value of stranded projects. We've shown that we're really good at logistics, and we've got infrastructure at the port that we're working backwards in. That's going to remain a huge driver of value and a big part of the Fenix story. We can replicate those opportunities elsewhere. We've got huge ambitions using our logistics capabilities to access both ends of the value spectrum, whether that's shipping, commodity-related opportunities or mining-related opportunities, is absolutely on our radar. And so we're going to, when they come up, we'll look at those opportunities. But our day-to-day operations are focused across the business. Myself, Craig, our teams at Fenix and our teams at Fenix-Newhaul and Newhaul are focused at the Midwest, and we're building a big business.
Yeah, we'll definitely get Craig on the next webinar, actually, so he can speak to some of these questions, because one came through on the Q&A, some chat feature about the fleet. Do you happen to know how old they are and if they're replaced on time or mileage? It's probably a Craig question, so it'd be great to get him on the next one.
Definitely a great question. One of the strengths of Newhaul is we do have a fleet replacement program. I think we've spoken about that, and certainly you see that in our CapEx disclosures. And if you're in the Midwest, you'll notice that, because all of the beautiful big blue road trains you see driving around, and perhaps you're going past with your caravan, they look brand new. They're clean, they're dust-free, and our drivers have the opportunity to sit in relatively new equipment. So the short answer is we generally do less than 1 million Ks out of our prime movers. Therefore, we're averaging close to 500,000 kilometres a year, which is almost unheard of in the bulk commodity industry. And so we're turning over the prime movers on roughly a 2-year basis. But Craig, as you're correct, Danica, would probably correct me and give more detail on that program and how it works. But certainly we've got a very strong relationship with Volvo. That fleet is state of the art, and it stays new and in very good condition.
Yeah, there's some absolutely amazing videos actually from Volvo they're actually on the Newhaul LinkedIn if anyone wants to check them out. One of them went viral, so I might share that in the replay video. I'll link to it. But you mentioned in the quarterly that you were going to expand the haulage fleet. What about on the rail side? There's the potential, you're evaluating the potential to use the rail sidings. Can you provide some more detail on that?
Short answer is probably no, but just a reminder for shareholders, part of the assets we've acquired are 2 very strategic rail sidings, one at Gringery and one at Riverton. We've actually own and control quite large parcels of land there. So both of them represent opportunities for effectively inland ports. Obviously, the key opportunity is to access the rail, but they also represent potentially blending locations, consolidation locations, and haulage-related efficiency locations, even using roads. And so we are investigating those, both for our own and also for other third parties. And we'll be updating the market when we see an opportunity to develop those and recommission them. Most obviously for rail network, the challenge there is obviously we're so efficient with our road haulage that traditionally bulk commodity operators wanted to get on rail because it was lower cost. In fact, for us, our challenge is how do we make the efficiencies of rail work for us when our road haulage is just so efficient. But there are other opportunities in relation to those rail sidings, and they will be a key part of our plans to unlock the Midwest.
Okay, and you touched on the blending of iron ore there, so that's a nice segue into Shine. I understand Fenix has completed a grade control drill program and is evaluating the recommissioning rather of Shine. Can you provide a bit more detail around that?
Sure. Look, Mount Gibson are a very well-credentialed miner. This project is shovel-ready. They commissioned it. It's a different sort of ore body to Iron Ridge, and so we want to understand and be very clear on a decision to recommission. We mine Iron Ridge differently to a lot of big bulk commodity iron ore miners. We use a lot of grade control in the pit. We mine it almost like a gold ore body, and that's why we've been able to maintain such a strong, consistent product spec, which is really appreciated by our customers. Iron Ridge is a 64% in situ ore body. Shine is a 58% ore body. So we're looking at that. We think there's an opportunity perhaps to update and refine the Mount Gibson mine model to a more Fenix-style model and flow that through the product quality. And that could be a key driver of value in that project. So that's what we're working on. Stay tuned for an announcement at this stage. Obviously, we haven't made a decision around when, how, and capital on Shine, and we'll be updating the market when we have.
Okay, I'm going to jump to the hedging now and the goals and parameters around your hedging program. Roger has asked if there has been any thought given to winding down the hedge in the future, and if that's not been given any thought, then what's the goal behind it?
Look, hedging is quite emotional for miners. When your hedges are in the money, it's great, and when they're out of the money, it's absolutely terrible. So one of the things we disclosed in this quarterly is that our hedging program cost us $4 million in the quarter. It's obviously offset by more than $35 million of positive operating cash flow because of that higher iron ore price. I think in answer to an earlier question, I spoke about our confidence in a sustainable business, and we've disclosed earlier, our C1 cash costs are stable at just over $50 a tonne. So we believe we're going to generate a margin in most, if not all, conceivable iron ore price environments. However, we also want to maintain a margin during those dips in the iron ore price, and that's the logic behind our hedging program. And we've seen that. It's been very beneficial for our cash flows during periods where we've seen lower iron ore prices. Currently got hedges in place for 50,000 tonnes at $170 out to June, with the iron ore price roughly around 200. You can see that that's they're swap contracts, so they're currently costing us on a monthly basis, and let's hope they continue to do so, because it'll mean that our broader business, both at Iron Ridge and Beebyn-W11 and Twin Peaks, possibly Shine and possibly elsewhere, is in really, really good condition, and we're generating those big margins. We've been quite conservative in our hedge program. We've made no change to that program, so we look to opportunistically lengthen out our hedges where we can, reminding the market that at 170 we're still locking in a very, very strong margin above our costs, and we think it's prudent to do so where we can.
Okay. And Mick and Nick have asked about other risks, I guess particularly the end market risk. China has been brought up. There's some growing uncertainty, at least in the media, around China's growth. Is that something that Fenix thinks about? Are you trying to mitigate that risk and seek other market? Do you have any comment on that?
Obviously we're a very, I think the iron ore business in Western Australia is in the hundreds of millions of tonnes. So we're a very small player in that market. We do have diversification though in our customer base though from Iron Ridge, and our products, as I mentioned earlier, are now quite well known in the market. So 50% of our offtake from Iron Ridge is with our partner Sino Steel Midwest Corporation, and 50% is held by Atlas. So, a lot of our product goes to China, but we're also exporting product to a range of customers in Asia, Malaysia, Indonesia, and other places, particularly friendly for Panamax-sized vessels that we ship from Geraldton and those shorter shipping routes. But that's a diversification of customer base. The reality, though, is that wherever your customers are, if you're producing iron ore, you're exposed to the China-related price cycle because they dominate the market and they set the price. During January, the federal government have announced their commodity outlooks, and I think there's a lot of very positive reality around the iron ore market. I mentioned it earlier in this call in relation to other commodities. The iron ore price is very strong at the moment, and there are strong drivers as to why that is. Everyone's bearish on it, and so let's pretend they're correct. And although I think there's a structural bearishness that always seems to be there in iron ore prices, but iron ore can drop a long way. It's still a very, very deep market, and there's a lot of margin there for Australian iron ore producers. Our challenge and our goal is to bring down our costs. 50 USC1, we want to be a lot lower. We've got the blueprints to building a bigger volume business that'll get us there. But I think even at our current cost of 50, with an iron ore price at $135, yes, we're interested in the China-related cycle. Yes, we watch it. But that analysis is somewhat in contrast with the fact that we continue to see very, very high spot prices and very, very strong short-term commodity markets. Delighted to be taking advantage of them.
Mm-hmm. Okay, so focusing on things that I guess you can control or can control a bit better than things outside of your control. Rosemary has actually asked a question. Are there any plans for further expansion of the company's asset base, and are there other partnerships and acquisitions on the horizon?
Yes and yes. You're seeing that we want to grow a big business. We think we're doing the work around what a 10 million tonne a year business looks like. and stay tuned for that. You can see in our business at Iron Ridge, add together the production that we are working on from Beebyn, from Twin Peaks, from Shine, and then think about the Midwest and all of those people. We're very interested in talking to anyone who's building a project in the Midwest, who's looking for a partner, who's looking for funding, and obviously we're working, as I mentioned earlier, with a whole range of partners. Most obviously the native title groups. And our partners at Iron Ridge, the Wadri Yamaji, but also the Midwest Port Authority and the state government, main roads, rail owners. We'd love to build a big business in the Midwest. We think it's the place to be.
Okay. Final question. I appreciate where we may have run over time a little bit. So you've clearly outlined in 2024 your goal is to augment the Iron Ridge production with new production from Beebyn-W11, Shine, Twin Peaks, and in addition expand your third-party services business to provide, I guess, a new profit generator for the company. Would you be able to neatly summarise for us all on this call a bit of a key milestones and what investors can look forward to in the next 6 to 12 months in terms of news flow and catalysts?
I think the really exciting opportunity for Fenix and why we're attracting great people to our team and not yet fully appreciated by the market is the opportunity we have to build a large-scale business. I remember when I was at high school, the various potential iron ore alliances and opportunities in the Midwest. They've been largely obscured by the challenges of building a new port at Oakajee. The material is there, the commodity is there, we've got strong commodity markets and strong logistics capability. So the key milestone, obviously we've got a few and we've mentioned them today, but we're working very hard on what the potential is and how we're going to put that together. So I think as we find the milestones and the pathways for Beebyn-W11, make a decision on Shine, and increase our production from Twin Peaks into Iron Ridge during the course of the next 6 months, I think we'll be able to lead the market, one, to a reality that we're going to generate a lot more revenue and more profitability, but also that we have the capability and the building blocks of a much larger business. At the moment, that's a description of an idea. What we need to do is put scoping studies, feasibility studies, and timeline around what that looks like. And we're really excited to be working on that, and we'll be disclosing that to the market as soon as we can.
Yeah, definitely look forward to that. Was there any final parting words that you wanted to leave investors with today, John? Jeff actually sent through a question on how you think the Wallabies might go in 2024.
Well, I'd say to Jeff that it's always good if you're underperforming to change the management. And we've said, obviously, a couple of my former teammates in Daniel Herbert as the new chairman and Phil Waugh as the new CEO have come in, and they're obviously very well-credentialed Wallabies to run Rugby Australia. What I would also say to Jeff is that I'm a lot more confident in Fenix's ability to win and work with our partners than the challenges that the new coach who's joined the Wallabies has in getting that particular organisation running. I think if you think about Fenix's business across our mining teams, our logistics teams and our port teams, there are some characteristics of the challenges of bringing really great world-class winning teams together. And so I wish the Wallabies good luck, but I'm sure everyone on this call is more interested to see how we're going to go with Fenix. Really, thanks very much, Dan. The December quarter was good. We're hoping to deliver better, so stay tuned.